Also with us, Managing Director of Kotak Mahindra Asset Management. Nilesh, good afternoon. Of course, we've been talking about this offline as well on how this demonetization is maybe really great move in the long term. But in the short term, of course, the markets are always worried about near-term earnings impact. Do you get a sense that that's now factored in and the market is ready to move on, or do you get a sense that maybe there could be some more selling which is left?
From a price correction point of view, probably at this level, demonetization has been factored in. However, from a time correction point of view, obviously we'll have to listen to or hear more good news. Like today, there are 3 news articles which has talked about one Paytm transaction exceeding debit and credit card transactions in the country. That's a positive move. Like the local municipality tax is collecting more than 13,000 crore in dues. That's very positive because they will be able to spend money on infrastructure. Third is that the state electricity boards have recovered dues. So we need some amount of this kind of positivity and adoption coming in economy to be one, a cashless economy, or to as much as possible cashless economy, if not full cashless economy. And second, an equitable distribution of taxation burden where rest of India follows salaried class in payment of taxes. If we can adopt these 2 things, then my feeling is that at this level, demonetization is more than factored in.
Nilesh, hi, afternoon. It's interesting you make that point about time correction for the market. You know, we were speaking with Samir Arora earlier in the morning, and he said that it would take at least 6 to 9 months for the market to return to that pre-demonetization levels. Is that a view that you concur with?
It all depends upon event. For example, it's quite unlikely, but let's say in December 2016, Fed does not raise interest rate. Then will our markets bounce back? Quite likely. On the other hand, let's say on February 1, again it's quite unlikely, but let's say the finance minister does not honor the path of fiscal prudence, which he had promised in FY 2017 because of the slowdown which is going to be caused by demonetization. Now, if that happens, then markets can correct. So it will be a function of events. We do expect Fed to raise rates. We do expect finance minister to honor fiscal prudence, and which is why it's difficult to predict what will happen in 6 to 9 months. If, as I mentioned earlier, if people adopt to cashless economy and people start paying taxes, then we could see recovery much faster than what people are expecting.
Nilesh, you spoke about Fed, and that's also another important piece in the puzzle, right? I mean, if you look at the emerging market index in dollar terms, that's also down quite a bit ever since the Trump win. And we've seen this big dollar strength with so much FII outflows. Do you think that could put some more pressure on the market?
Now, Anuj, as you correctly mentioned, it is the FII selling along with demonetization which pulled market down. If there was no FII selling led by rising US yields and stronger dollar, probably the impact would have been much lower. Now, in December 2016, market believes that Fed will hike rates by 25 basis points. So to that extent, it is very well known and very well discounted by all markets. The worry is what kind of guidance Fed will give. In December 15, after raising interest rates, they gave a guidance that we will hike interest rates 4 times in 2016. That was not discounted by the market, and it spooked not only their market but also our market, and we fell in Jan and Feb 2016. I hope with the new presidential election and the experience of 2015 December, hopefully Fed's guidance will be more like we will, look at the data and then take a call, rather than an aggressive guidance that we are going to raise interest rates 4 times. The market hasn't discounted aggressive guidance from Fed. Of course, they have discounted Fed's ability to raise interest rate if economy responds.
So what do you do with individual stocks, Nilesh? Are you guys pumping in some money now? Because I remember you telling me that, for good quality companies, it's best to put in money when the times are tough and when the sector is going through a challenge. So would this be a good time to put in money into, say, an Asian Paints, which has fallen 25% from the top?
My feeling is that as a fund manager, we don't have the luxury of sitting on cash. Sure. We can at best recommend customers their asset allocation in terms of how much to put in equity and how much to put in debt. And certainly at 26,000 level of Sensex, it's far better to invest than at 29,000 level of Sensex. And in today's environment where there is a significant amount of correction in certain mid caps as well as some large caps, it is opportune time to relook at your assumption and then invest. In our opinion, we are seeing a very big trend emerging, which is of unorganized sector to organized sector. Couple of distributors who accept credit card are gaining market share from those shopkeepers who only transact in cash. The same analogy will get extended into other side of economy where unorganized sector which are thriving on cash collection, which are thriving on tax arbitrage in host of sectors will yield market share to organized sector, which will be more tax compliant, which will have better supply chain management, and which will be able to transact on credit or in non-cash items rather than only through cash. So we are looking at that sectoral gain for organized sector where we could see faster growth and probably higher margin.
All right, Nilesh, thanks a lot for